I want you to talk about the banks that have gone under within the last few days. Silvergate, Silicon Valley, and Signature, and the impact that that has had on crypto. But first, can you walk us through how exactly these banks collapsed?
So the banks collapsed, each because of a concentrated level of exposure to a particular industry or a niche in this economy, either specifically crypto or really kind of like tech in general. Silvergate really kind of started all of this when back in November it was revealed to be a debtor to FTX for I think a little over $1 billion, about 10% of its total deposit base, and a lot of questions around that time were swirling, if you remember, from senators and people in Capitol Hill to just customers wondering if Silvergate helped perpetuate any of the alleged crimes at FTX by sending customer dollars that should have gone to the exchange to Alameda Research, its sister hedge fund, and kind of like what it knew and when. That led to a massive run on the bank's deposit base, I believe, to almost $8 billion. The bank did not have enough cash on hand, so they were forced to one, take out about a $4 billion loan from the Federal Home Loan Service Bank. Remember, about 40 years ago, it started out as kind of a sleepy little regional bank focused on mortgages with an AUM of about, I think, $40 to $50 million. And then they also had to liquidate a portion of their bond portfolio at a loss. And kind of all of those things together were problematic. However, they did meet all those withdrawals, and I think that there was some hope that the bank would be able to rebound as the market recovered and kind of ride the wave back up. I know in particular some hedge funds and kind of professional money saw Silvergate as a very cheap option to bet on a market recovery. Unfortunately, that kind of came to a head about a week ago when the bank announced that it was going to have to delay filing its annual report for 2022. Turns out that it had to liquidate even more securities than were initially reported, and that they had to redo some of the accounting work that they had done in the past year. And basically, when that happened, everything sort of came apart. There were more runs, and the bank eventually started working with the FDIC, started looking for a buyer, and then decided to liquidate. One thing worth keeping in mind is that while Silicon Valley Bank and Signature Bank failed, Silvergate did not, but that doesn't mean that it was not going to at some point in the future.
Steven, obviously, within the first few sentences of your explanation there, FTX came up. Obviously, my ears perked up. FTX was, dare I say, a black eye in the crypto industry at the end of 2022. So is it fair to say that the crypto industry is still feeling the ripple effects from the fallout of FTX?
I do think it's fair to say that. I mean, not in the direct way that I think many people would kind of anticipate. For instance, I mean, FTX did not have much bleed over into the traditional financial markets, and although according to some of the more recent statements from John Ray, the current FTX CEO, there's still almost a $9 billion balance sheet hole in the company, which affects U.S. customers and customers around the world. That would be the direct way, but obviously a lot of the trouble with Silvergate started because of its association with FTX, and it's also worth pointing out that FTX did bank at Signature. It did not, however, have a bank account at Silicon Valley Bank. That one thing actually worth noting is that Silicon Valley Bank, it was focused more on tech in general, and it was actually I actually spoke to an employee at the bank on Friday before it collapsed on background, and was told that less than 10% of its customer base was crypto clients. So Silicon Valley Bank probably should not be considered a crypto bank, but yes, it's true. FTX sort of I think precipitated all of this, at least in an indirect way, because of rumors and fear and uncertainty about the nature of its relationship with Silvergate.
Steven, it sounds like it's not a good time to be a three-letter abbreviation: FTX, SBF, SVP, Silicon Valley Bank. Was Silicon Valley Bank the worst of the three collapses? Because that's the one that's been in the headlines the most.
It's I guess it would be the worst in the sense that it was the biggest. It is the second biggest collapse in U.S. banking history, behind Washington Mutual back in 2008. I mean, Silicon Valley, though, it's a very unique case because it ballooned into it rode the wave of all this cheap COVID driven largesse where I mean every other day we were reporting about a venture fund raising uh, a multi-million dollar fund to invest in startups. And I mean, frankly, on the Forbes crypto beat, we almost got to the point where if a startup was not raising a nine-figure amount, it almost wasn't big enough to even fall on our radar for coverage unless there was something very special and unique. And Silicon Valley Bank wrote all this to almost or to about $200 billion in deposits, and they had all this money, and it kind of left the bank with some interesting choices to make. I mean, for instance, this was still a period of ultra low interest rates, so investment opportunities were relatively small, and the people at Silicon Valley Bank, although management clearly has some things to answer for, are smart people. So they tried to be safe. They invested in treasuries and long dated mortgage bonds and et cetera, and earned like measly types of yields, or were going to. And they just kind of made a bet that there was never going to be such a big rush of funds or withdrawal requests that they would be forced to liquidate at losses and sort of scare their customers. And to be perfectly frank, they read the market wrong. I mean, 2022, interest rates started rising. All these fixed rate bonds that they purchased, soon the value of them fell, so they were underwater. Silicon Valley Bank was forced to liquidate, I think, about $21 billion of its portfolio at a $1.8 billion loss to help process withdrawals, and that led to even more investor fears. $42 billion left the bank on one day at the end of last year, and it really is kind of in some ways it seems like a very obvious problem to present a bank that got all this money that basically was just given out for free to try to stimulate the economy. Everybody knew that interest rates were going to rise, but at the same time, you didn't know when or by how much, or it's hard to judge people and kind of what clients would do, especially if they were concerned about the safety of their deposits. I actually did speak with a senior examiner at the FDIC over the weekend, and he even told me that while Silvergate management clearly misread some things and that there were problems at the bank. In fact, it was kind of intimated to me that the FDIC sort of forced Silvergate to produce what's considered to be like a living will document in December to help process an orderly wind down of the bank should something happen. At the same time, I was also kind of told that had Silvergate not happened a couple days before, there's a very good chance that Silicon Valley Bank might still be in business today. One other thing that he did mention as well is that it is possible that some of the reforms initiated under the Trump administration to kind of deregulate banks perhaps saved Silicon Valley Bank from having to do some of the stress tests and other types of requirements that tier one banks must adhere to, which again could have maybe given some warning signs about all of this happening. But at the same time, it's hard to forecast like a major crypto bank happening right before this and some of the exact events that transpired. So it's hard to know exactly what will happen, but obviously regional banks are under duress right now, even with the federal actions to help protect depositors, and especially when you're a regional bank that's exclusively focused on very volatile industries, whether it's crypto specifically or tech at large. There's some you need to be very careful in how you manage your risk.